Hi everyone. In this chapter, we are going to focus on chapter 11. Basically, we will start chapter 11. That's the start the topics of chapter 11. We will start lecture 20 and finish half of it, and the remaining half we will cover it next week in a separate video lecture. So this video lecture is basically your lecture 20 part 1, but lecture 20 there will be a part 2 which will be coming next week. But for this week we will focus on just the first half of the chapter as well as first half of this lecture. Okay, so in the US basically we have a fractional banking reserve. Okay, the main reason we use banks today, the main reason we want to keep our deposits in checking accounts or saving accounts rather than keeping the cash money in our home is because of safety and convenience, right? Because it's if we keep $10,000 $12,000 at home, it may not be in cash, it may not be safe. If the robbery happens, then we will lose all that money, right? Also at the same time, it's convenient because we don't have to carry so much cash with us. We can use a debit card or we can write a check and make payments. So the main reasons we use bank is because of safety and convenience. Now in the US we have fractional reserve banking, or also known as the Goldsmith's principle. What that means is when we make a deposit into the banks or into the checking accounts or saving accounts, banks will only hold a portion of that deposit, and the remaining money they will use to loan out in order to make money or in order to charge interest and make profit. So let's say what I'm trying to say is basically, let's say I put $100 in my checking account in Wells Fargo. What Wells Fargo will do is basically in their cash vaults, they will only keep $10, and the remaining $10 or $20 and the remaining 90 or $80 they will loan out to businesses or other individuals so that they can charge interest and make profit using that money. Okay, so that's known as the fractional reserve banking. They're only keeping a fraction of your deposit in the banks in their vaults, and the remaining they are giving out as loans to make profit. And this policy is controlled by the Federal Reserve Bank. In other words, they're basically controlling the money supply under the fractional reserve banking. So under the direction of Fed, banks are required to hold only a portion of the depositor's fund on reserve. The portion depends on the size of the bank and other factors. Most of the time it's usually 10%, but it can vary depending on the location, the type of bank, the size of the bank, and other factors. So basically, again, what this is saying is Fed, in order to control this policy, they don't want the banks to give out all the money supply or give out all the depository as loans. They want the banks to keep at least a certain portion of the deposits as money or as cash in their vaults, such as, let's say, if we are saying 10%, so if we are depositing $100 in the bank account, Fed would require that the bank keeps $10 as cash, and then the remaining $90 they can loan out to businesses and make profit. Now this 10% can be 20%. In that case, they will have to keep $20 in cash, and the remaining $80 they can loan out. So this is a requirement for Fed to control the money supply. This is a way in which they can control money supply. This is known as the reserve requirement. We will learn about this in chapter 12 when we talk about monetary policy. But basically, this is one way we can control the money supply. This is one way the Fed controls the money supply. The Fed basically requires the banks to hold a certain percentage of their deposits as cash because they want to control the money supply. If they want to increase the money supply, they'll probably lower this reserve requirement. If they want to decrease the money supply, they will probably increase this reserve requirement. We will learn about this more in chapter 12, but so far just know Fed basically monitors these programs. Fed requires the banks to keep a certain percentage as cash for all the deposits made, and the rest can be the banks can make out loans in order to make profit. The Fed basically does this to control the money supply. Okay, then we shift our focus. We talked a great deal of, we did discuss a lot about Fed in chapter 10, when we talked about money and what and Fed, what are the functions of Fed, how can they control the money supply. We will learn more about Fed in chapter 12, but right now we're going to shift our gears to commercial banks. So commercial banks are basically, Bank of America, Wells Fargo, Chase, or even the smaller community banks, such as Pinnacle Bank, Prosperity Bank. These are all commercial banks. They basically provide banking services and loans, and they do that in order to make money, in order to make profit. They are here for commercial reasons. Okay, and the function of a commercial bank can be explained through their balance sheet. So what is a balance sheet? Balance sheet is basically a statement that gives us information about the assets, the liabilities, and the equity of the bank. Okay, and based on by looking at the balance sheet of the bank, we can figure out a lot of things about the operations of the bank, whether they are giving a lot of loans, or whether they have a lot of checking accounts, or whether they are buying or selling more securities. So the balance sheet is a very important information sheet for the banks, because again, we get a lot of information, whether they're making loans, whether they're giving less loans, whether they have a lot of accounts, checking or savings. So we can all find this information from the balance sheet. Now, one thing I want you to remember is balance sheet is at a particular point of time. It's not over a period of time. So if we say balance sheet as of December 31st, then what are the assets, what are the liabilities, and what are the equity of the bank on that particular day? It will change from day to day, but we look at balance sheet on a particular day. So basically, let's say if we say the balance sheet of Bank of America on December 31st is given, then those are the assets, liabilities, and equity of Bank of America on that particular date. Now, we all know, before we also learn, assets is equals to liabilities plus net worth. This is also an accounting equation. Asset is basically the total value of all the resources. So if in case of banks, banks, if somebody owns cars, if somebody owns buildings, if somebody owns cash, these are all assets. Liabilities are basically claims by creditors and depositors, and we will discuss about liabilities for banks more in details. And the net worth is basically, it's the value of investment by the shareholders or stockholders. When shareholders are investing money into the bank, that will go as net worth or equity. Equity and net worth can be used interchangeably. So, for commercial banks, customers, customers like us, like you or me, if we go to Wells Fargo, we can be a liability or we can be an asset. Depends on our purpose, right? So let's say if I go to the bank now and if I deposit money in my checking account, I am depositing money into the checking account of Wells Fargo, then in that case, I am a liability for the bank, right? Because the bank, the money in the checking account is an asset for me, but for the bank, that is a liability, because the bank has to pay that money back to me. Anytime I want to go back to the branch and I ask them to give me back my deposits, they are required to give me back that deposit, right? So basically, the money that we keep in checking account or savings accounts or investment accounts, this is our asset, but from the point of view of the bank, think from the point of view of the bank. The people are keeping money in my place, and anytime they can come and take it back. So for the banks, it is a liability. When we keep money in the account, it's a liability for the bank because they have to pay us back. So in that case, customers are a liability. But on the other hand, customers can also be an asset to the bank. How is that? If we go to the bank and we ask for a loan, a personal loan, a car loan, a home loan, or a business loan, if we are taking a loan from the bank, then in that case, we are an asset, because in that case, we have to pay back the bank. We have to pay back money to the bank because that's their money which they gave it to us to buy something, and we have to pay back that creditor. So basically, we as customers can be liability if we are depositing money in their accounts, or we can be an asset if we are taking a loan from the bank. Okay, now when banks deposit funds in the Fed, like remember in the last lecture I said Bank of America can have checking account with the Fed. In that case, that checking account is that checking account with the Fed is an asset for the commercial bank or for the Bank of America, right? Because they are putting money in the Fed and Fed is required to pay them back. So that is an asset for the banks. If the banks are keeping money in their vaults, the cash in their vaults, that's an asset for the bank. Okay, so we have to remember these things. Let me do a quick example, and you guys have to know how to prepare a balance sheet given when I give you some information, you have to arrange them into a balance sheet. So basically the example that I will do now will help you to classify the items into assets, liabilities, and equity, and at the same time I will show you how you will need to arrange it into a balance sheet. Okay, so let's say you are given information for a local small bank called Pavilion Bank. Okay, let's say you're given information for Pavilion Bank, and here are the statements you're given. Pavilion Bank is a small community bank in Dallas with very limited operations. It has a total of 500,000 in all its checking accounts. So basically these are the checking accounts that customers have. The balance on those checking accounts is 500,000. Okay, that's the first one. Then we are also said that it has savings accounts for customers and the balance is 750,000. Okay, then we are given a second then we are given another information that the bank owns two vehicles and each of these vehicles, the value of each of these vehicles is $20,000. That's each. Okay, so basically each car, the value is $20,000. And the bank also owns we have this information, also owns a building, basically the branch building, and the value of that building is 1.2 million. Okay, also the bank has a deposit account with Fed. The Pavilion Bank keeps some of its deposit with Fed and the balance of that is 400,000. They also made out some home loans and car loans, and the total value of all the loans right now is 425,000. Okay, and finally you say they also hold some cash in their vault, you know, the big machines they have, they keep cash in there, and right now the cash that they have on their vault is 100,000. Okay, so this is the information given, and let's say we take today's date, and today is, let's say, assume is 4/21st, which is April 21st, and based on this information I will ask you prepare the balance sheet for Pavilion Bank and calculate total assets, liabilities, and net worth of the bank. So that's my question. Basically, I give you this information, I give you the date, and then I ask you to prepare the balance sheet for this Pavilion Bank and calculate the total assets and net worth and liabilities of the firm. Okay, so the first thing we will do is how we prepare a balance sheet is always in order to prepare a balance sheet, we will first write the name of the bank on top. So it's Pavilion Bank or name of the company or whatever, you know, it's Pavilion Bank. Okay, then we write balance sheet and then we will write the date, and as we know, we said the date is April 21st, so we will put April 21 2020. Okay, so that's the first part. Then we will split it up into a table. Okay, on the left hand side we will have assets. Okay, so on the left hand side we will list all the assets of the bank. On the right hand side we will list the liabilities on top, and we will list the net worth at the bottom. That is the format for the balance sheet. So make sure you understand this format. If I ask you in your exam, or if I ask you in your homework, you have to prepare a chart like this. On top you write the name of the bank, then you write balance sheet, then you write the date, then on the left hand side you write assets. We will list all the assets here, and at the end we will calculate total assets. And here you calculate, on top of the right hand side you will put liabilities, and at the bottom you will put net worth. Okay, so now we know this. Now let's now calculate, or let's now list, okay, based on the information that we're given. Okay, so the first information we are given is Pavilion Bank has 500,000 in checking accounts in their branch. So basically customers went to Pavilion Bank and deposited money, and the total amount of money that Pavilion Bank has in their checking account right now is 500,000. This means that Pavilion Bank has to pay back this 500,000 to the customers. Anytime these customers come and want this money back, Pavilion Bank has to pay it back. So that means it is a liability for Pavilion Bank. So we will put checking account 500,000 under the liability, because they have to pay this back to the customers. Same way the savings account, the savings accounts, they have 750,000. Again, this is the account of the customers. Anytime the customers come and ask to return this money, they are obligated to do so. So this is a liability for the bank, and we will list it here. Savings account is a liability, so we will put 750,000 on the under the liabilities category. All right, so then we say the bank owns two vehicles. Basically they own two vehicles, and each of them is $20,000. So that's an asset. This is something that the bank owns, so we will list it under the assets. So vehicles, and there's two, so basically if we see 20,000 times 2 is going to be 40,000 total in vehicles or cars. Okay, the next statement we have is building. They own a building. The bank owns a building for 1.2 million. That's an asset. They don't have to pay back for it. They own this building, so the building value will be under assets, which comes out to be 1.2 million. Again, 1.2 million. Okay, then we go up. Deposits with Fed. Okay, bank has kept some money with the Fed, so anytime they can go to the Fed and ask the Fed to give back that money. So that is an asset for the bank. So the deposits, when banks have deposits with Fed, remember the slide, that's an asset. So deposit with Fed for 400,000 is an asset to the bank. Okay, the next one is the bank made out loans of 425,000 to customer. For customers, for us, we have went to the bank and we took a loan of 425,000. So for us, it's a liability, but in terms of the bank, it's an asset, because we are going to pay back the bank. Basically, bank gave us money, but we need to pay back the bank. So anytime bank comes and asks for the money, we have to pay it back. So basically, that's an asset for the bank. So loans will be reported under assets under the balance sheet of the banks. Loans to customers. Okay, now if the bank takes a loan, that will be a liability. Let's say if the bank takes a loan from Fed, then that will be a liability. But if the bank is making out loans to customers, and we as customers have to pay back the bank, then that is an asset. Okay, last we are given cash in vault. So the bank has cash money and they kept it in the vault in their branch. That's definitely the money they own, therefore this is their asset. So we will list cash in vault under assets as well, which is $100,000. Okay, so that's how we have listed our items into a balance sheet, but that's not the end of it. We do have to calculate the total assets, total liabilities, and net worth of the bank. Okay, remember that's part of the question. If you scroll up, see, I asked prepare the balance sheet for Pavilion Bank and calculate total assets, liabilities, which is L, and net worth of the bank. So you have to calculate total assets. So in this case, at the very bottom, you will write total assets, and it will be equals to, basically you will add all these numbers, 40,000 plus 1.2 million plus 400,000 plus 425 plus 100,000. If you add all these numbers, it comes out to be 2.165000. That's the total assets the bank owns. That's the total value of resources that the bank currently owns, or on that day they own. Okay. What about the total liabilities? Same way, we have to calculate the total liabilities, and under liabilities we only have two categories, checking accounts and saving accounts. So if we add them up, we end up with 1.250000. So that's total liabilities. We have calculated total asset, we have calculated total liabilities. Now we need to calculate net worth. Remember, net worth is assets minus liabilities. So we know total assets is 2.165000 minus liabilities is 1.250000, and that is equals to 915,000. That is your net worth. Okay, so that is how a balance sheet will look like. We will be given with a statement and a date. We have to first write the name of the bank, then write balance sheet and the date. Then on the left hand side we will list all the assets and sum them up to find the total assets. On the right hand side top we will list the liabilities, then we will find out the total liabilities, and at the bottom of the right hand side we will calculate net worth, which is basically your assets minus your liabilities. Okay, so hopefully this is clear, and hopefully you understand what a balance sheet looks like. Whoever took an accounting class, probably this is very easy, but for someone who's new to the concept of balance sheet, this is a perfect example for a bank, how you can organize the data into a balance sheet, and based on this you can tell a lot of information, or you can deduce a lot of information about the operations of the bank. So people use banks to deposit money into their checking accounts. When we get salary or when we get income, we deposit into our account and write checks in order to buy things or in order to pay bills. Using a debit card, or we sometimes use a debit card in order to buy things. When we go to the grocery store, usually we will use a debit card. Some people use debit cards. So that's one of the reasons why we use banks. People also use banks to make deposits in their savings accounts, because savings accounts pay an interest to your deposit. So the money that we don't need now and the money that we will use to buy some future assets, we will probably keep it in the savings account. Let's say a part of my income I will probably keep in my savings account so I can buy a home after 10 years or after 5 years. So we also use banks to keep money in the savings account, and this money they don't need right away, because this is for a future plan, and bank pays interest on that. And another thing is, basically, when banks meet all the regulatory requirements of the federal and state government, they are known as going concern or active business. So for this lecture, I will stop here. From next class, I will start from slide 9 and I will finish this lecture off. I just wanted to start the commercial banking topic and give you an idea about what they do and how their balance sheet looks like. In the next class, we will talk in details how they play an important role in the money supply of the economy. But for this week, we will only cover up to slide 8 of lecture 20. You guys stay safe. If there's any question, feel free to email me or send me a message, and I will be happy to help you. Thank you.